Welcome to Insights. I'm Eric. Thanks for joining us here in 2022. We're going to take a quick look at the matrix here, a quick look at some of the changes. I'm going to focus in particular in the timing of correction crash section, which has been slowly modified for some time. Maybe we'll include this inside a help video eventually. But in terms of the timing of correction, it is down on line 137 and below. It represents the computer's attempt to go through the complex nature of everything that we see inside the matrix. We tend to focus on individual markets, but there's a lot going on here, and there's a lot going on inside the intermarket trends as well as the U.S. economy and some of these longer term cycles. And again, something that's probably overlooked quite often is the long-term seasonal cycles and the seasonal cycles. And so now we've incorporated that for it to be automatic. What I have included just recently is this warning up in here. If the timing percentage goes to 50% or higher, this warning is generated for everyone to look at. It makes you go down to line 137, and that's what we're going to do right now. So everything below here. From a standpoint of some of these things, it's not like you're looking at something that's brand new. I've incorporated a lot of this in 2021 towards the end of the year. Just didn't explain too much of it. This up feature right here is kind of risk on, risk off, junk bonds relative to high grade. Gives you a flow of risk on and off. It's not really involved with the timing crash section. It's something to keep an eye on. It's still risk on for the economy, but it isn't in part of the crash section. Everything here that's numbered is included, and the computer does calculate percentages off of them, and I've included check marks for the computer to check something that's important in case you want to take a look at it. The first thing is sentiment. We've all long known about sentiment. In this case, it gets a check because the oscillator is in a bear cycle. The next one is the Vix model. This is one of the more important timing models inside the matrix. These two components within the crash or correction section are quite important. That's why they're highlighted yellow. Neither one of them are checked. Both are in a bull state. They could get knocked down, a DI rated of -40 or lower, or it depends on the intensity of the reading. The computer will study that. It still has not yet to check this, but this could happen relatively quickly if the stock market continues to rally and these numbers drop. But so far, none of them are checked. We've seen trend correlations before. These are the decoupling, trending sections. These account for two of them. Everything is pretty much trending. Again, you don't have to look through the matrix anymore. You just come down to this section. And really should come down to this section when it's flashing warning up here. We have the S&P 500 Treasury ratio, which is an intermarket flow. It currently favors the stock market. It is checked, not because it's the direction. It is bull phase for the stocks. It's the duration of the cycle. The time cycle is 2 standard deviation, and this is warning us that the bull phase is getting too concentrated in terms of time. Now, this can extend much higher than 2 standard deviations. It can go probably 2.5, 3, or maybe even 4. It's hard to say. Depends on how much enthusiasm. It's just that it has to get a check once the cycle gets triggered, and this is something that is a warning. So this is one of them. The other one is the economy. This is a complex discussion. There's a lot of information inside the economy. You get some of it here. A computer studies more of it. It is looking at it right here from this standpoint. It's making no comments in terms of any severe warnings yet. I think you'll get some more or less when the long-term oscillator falls below 0. Right now, it's the intermediate term is falling below. It's negative. That's why it gets a check. It's kind of like a provisionary. This will get stronger as this one falls below 0. If it does. If it doesn't, then this is a short blip. The long-term dividend cycles, which are further explained in the economic and stock report, which I've lowered down to $50 because in January, into the end of the January, because I feel it's an important report. I know a lot of people have participated in it already, but I don't think enough have. In one of it's a series of videos. I think there's 3 or 4 of them now. And we do discuss the dividend yield cycles in more detail. Right now, two of them are showing a warning and a bearish concentration, which is troublesome because these are some of the longer term ones. And there is more here. They're up in here. I suggest you keep an eye on this 1 through 6 model as well. This goes, you have some real problems, but we already have a problem in terms of the timing model. So therefore, it gets checked. If these get below, and if there's warnings that come up here, it's going to get worse. The more that are showing, the worse this is, but it's already getting a check. So that's why the crash percentage is close to 50% already. And an important addition here is seasonality. Now, seasonality we've talked about a lot in terms of individual assets up over in this part of the matrix. You see the stock seasonality, S&P 500, NASDAQ, small caps. Those are all important. Right now, the model is really focusing in general, this general one, focus on the S&P 500, but I've included the long-term seasonal cycles, which I'm have a hunch that many of you have not been using regularly. And it is right up here in line 135. And I get it, there's a lot of information to parse through. You can click this link and it'll download from the cloud, but I just started to have the computer interpret some of this stuff for us. These are the seasonal cycles. These seasonal cycles go back to 1925, which is much further than the normal monthly seasonal cycles, which go back to 1950. These are also risk-free or risk-adjusted, so they look at spreads relative to the seasonal cycle for large caps, small caps. These are some of them. There's a few other ones. I think gold stocks are in there as well. Relative to risk-free assets, which is the Treasury bill, which essentially means that you're spreading the two assets, and anything that produces a positive return means that you're going to get outperformance of large cap or small cap stocks or any of these things relative to Treasury bill yields over a 1 month period. And you can see that through just since 1925, without any parsing out of cycles within them, the large cap stocks tend to do and small cap stocks tend to do pretty well in the first month here, and that's what it's showing us. And corporate bonds are what is a little bit of warning for the seasonal weakness, but that's not a part of the crash and timing correction model for U.S. stocks. Down below is this parsing out even further information. It's taking a look at the 4-year cycle, which is a well-defined business and political cycle. Since we have so much stimulus and so many hands in the cookie jar today, you can't really study things without understanding where we are within the 4-year cycle. And you can see that seasonality shifts even more, especially now that we're in year 2. This is year 2 of a 1-month seasonality for the first month of January. And they're all bullish. So none of this reflects anything that would get checked. As the calendar now flips into February, this might change, and the computer is consistently keeping an eye on it. If you see anything that shows up here, I encourage you to go up and study this table here and take a look at what's really going on. But this is an important addition. The seasonality plays a big role. Too many people short the equity market or buy something during seasonal strength, or vice versa. They buy it during seasonal weakness, and it's good to know where that lies. Except seasonality goes much further back than 1990 or 1950. This one's back to 1925. I have seasonal trends that go back into the 1800s. For now, I haven't decided not to include that because it's just too much information. It doesn't really change these long-term seasonal cycles back to 1925 too much, so we're just going to go with these for now. But I encourage you to stay on top of this, but the computer will be there as well. What I've also included is down here in the last section. These are things these are capital flows from the flow of funds. This suggests household concentration in stocks, which itself is a warning. These are also based on the revenues that being collected. It kind of shows an upside limit of the not stock market, but of the overall economy in terms of taxation, how much it can actually collect. And what the computer will do is it'll warn when the economy is running hot here or here. Right now, it's not there. It's already generated a warning because this is a warning and this is a warning. But as this moves up, this will become even more of a warning, and you can get a clean sweep across the board. These tend to stay in place and people mostly ignore them. The problem is during major tops, you get a clean sweep across three of these below. So keep an eye on these. This is one of those that if you have the box checked and there's nothing else there, I wouldn't worry about it too much. But if you have a clean sweep and there's a lot of other things going on, it is a real concern for shorter term timing and intermediate and longer term, especially if these are flashing a warning and other things. These are capital flows and intermarket flows that are much longer term. So these are an important part of the timing mix, which most people don't even pay attention to. But the computer is now doing that for us. So these are important additions that we've made within the timing and correction crash section down here below line 137. So I hope everyone incorporates this into their analysis. Again, when you open up your matrix on a daily basis, if you don't see this time, you probably don't have to go down there. But if you see this shifted colored red warning us, go down to that section. I suggest going down there and being familiar with what's taking place. So thanks for coming by and learning about some of the updates that we've made. There's others, but we'll talk about them later. If you have any questions, let us know. Contact us directly. If not, thanks for coming back in 2022, and I'm sure we'll talk to you again real soon.